timing wise, is this the right time to take a closer look? What should one be focusing on this time around? What are the essentials, and what kind of goals should one have when looking at their savings portfolio?
Hi, Abha. Great to be here. You just talked about the timing, and I'm so happy that we're having this conversation in the first month of the financial year rather than the last month of the financial year, especially because I think it's so over-concentrated with everybody looking at doing their last-minute tax savings. So I think this is the perfect time. And a lot of reasons for that. This is the time of the year when individuals are getting their bonuses. There is increment in salaries. Freshness is there because, of course, we went to the new financial year. So it is the time to, take a look at what is your income now, the new income that the person is getting. What are your particular, expenses which have been ongoing in the previous year, and if there is an increase in them. Do you have any new goals? So you have to go back and reevaluate your financial goals as well. Secondly, Abha, I think it is also a great time to look at your debt portfolio. If you have a home loan, if you have a car loan, go see if somebody is looking at paying up the loans during the financial year, especially high interest rate products such as credit card loans and personal loans. I think that should be one of the priorities before you actually start to restructure your investments. So looking at your all sorts of debt and loans on an individual. Another thing here is very crucial. This is also the time to check your essentials. Essentials are including your emergency corpus, your life covers, and your health plans. Usually, if an individual is getting a bonus, it is easier to set aside, a sum to sort of set up your emergency corpus if it wasn't existing. So I think from that point of view, it is a great time. Tax planning, again, this is the perfect time to relook at that. And tax planning, I think, is a very, very integral and a very important component of your overall financial planning, because a small contribution of 1,50,000 a year can actually give you in a span of 35 years, can give you a corpus of about 7 crores if you're using the right instruments. So it can actually sort of cater to a bigger goal that you have set for yourself, let's say 60% of your retirement basket, or something else, which is those many years away. And finally, I feel what happens is that over a period of time, as we keep earning, our lifestyle changes and our expenses increase, and unknowingly, the expenditure basket that we have keeps on increasing, but we usually don't go and check that. And with every increment in salary, there is a little lifestyle modification. You probably are shopping more, you're traveling abroad, maybe instead of travel twice abroad, maybe it's thrice a year. So I feel that with every increment in salary, it is so crucial to set aside an incremental amount of investment as well. And that little, even 1,000 increment every year that you make, I think can really cater to that increase in your lifestyle expenses.
So how should one look at asset allocation in order to make the most of some of the concessions available? Is it primarily fund focused? If so, what kind of funds should one look at as well when thinking of building their portfolio?
So I feel, Abha, this is personal finance is so personal, and the best way to look at is define your own financial goals. It is almost like if I need to go to the market, I should know that, okay, the market is a kilometer away. Do I want to drive down to the market or just walk down to the market? So when you know that what is your final objective, it becomes very easy to choose the right product, which can enable the individual to actually meet your objective and reach their financial goals. So for financial goals such as retirement, which usually would, which are long-term goals, I would suggest that, the equity component of your portfolio has to be higher. Of course, supplemented with good products such as the employee provident fund. But of course, we've seen a little cut in the interest rates there as well. And one is investing for something in the near term or medium term, then of course the preservation component becomes a priority. Maybe the person doesn't want to take too much of risk. So there the combination of a debt product, a fixed income product can be in higher proportion as compared to equities. And that's how you sort of set up your overall asset allocation, and of course your own comfort, because your risk appetite is very, very crucial here in defining what is your comfort zone, and where do you find peace. Because if somebody is investing out of their comfort zone, I think they would make those sort of uncalled for exits, and they won't stick through the journey, especially in equities. So it's very important to have a overall asset allocation based investment chart for yourself, but considering all these factors.